joining us for a further look on what's playing itself out in the market scene is Sithembile Bopela from FNB Wealth Investments. Sithembile, always a pleasure and good afternoon to you.
Good afternoon. Great to be back with you again.
Fantastic. Oh, it looks like a bleak start to the week here in South Africa, but even in Europe. Let's just talk about what markets are contending with today and maybe even this week. I think some of it is, based on what we're supposed to see this week.
Yeah, so I think, the markets have had quite a lot to digest in the previous week. There's been quite a few data releases in the US, as we know. The earnings season is well underway there. And so also we've seen, economic releases, but also just the expectation of what the Fed is likely to do going forward has really been the major drivers of sentiment across global markets. I mean, US GDP outperformed expectations for the fourth quarter with a growth rate of about 3.3%. They likely pointing to continued strength and continued resilience in that economy. And so I think despite the Fed's very aggressive fight against inflation, that economy rather has remained quite resilient. The consumer remaining very resilient, and so some of that perhaps feeding into expectations that the Fed might not need to be as aggressive in terms of cutting, given that that economy is still quite robust. We also saw, in Europe, as you mentioned, the ECB decided to hold their policy at a historic height of about 4%, which is underscoring their anti-inflationary stance. They're still seeing, or rather at the time, still seeing, that the fight against inflation is still ongoing, which, backed by, the current geopolitical and political sort of risks to inflation that are prevailing right now, we can expect that, the sort of the language around us, higher for longer, being maintained. But there has been some division within that central bank because of some hints, at least, at certainly cuts coming through earlier than anticipated. But yeah, I think generally markets are contending with, or rather market participants are contending with a number of international developments, but also local developments. We have had a few releases locally that have been also quite a mixed bag, and so definitely quite a few things to read through for investors.
I want to stay in the US because what we're also expecting this week is some mega cap earnings there. I think 5 of that magnificent 7's. Keen to get your thoughts on what we can anticipate coming out of these companies: Google, Microsoft, Apple, Amazon, as well as Meta platforms there. It could be a mixed bag, but keen to get your thoughts overall.
Yeah, I think these companies have driven much of the market returns that we've seen in the US, the S&P in particular, which is dominated by these stocks. And so I think the AI story has been very central to what has been driving these returns for these companies. And so I think the outlook from management, as much as the performance for the quarter will be key, but I think the investors are largely going to be looking at what are the outlooks from the different management teams in terms of potential performance going forward, and what this AI boom or boom rather has in store for these counters going forward.
Let's move on now, maybe bringing it home and looking at the JSE today. We're seeing our miners down quite a bit. Lots of these miners are miners that actually export to China, of course, with the news of what's happening with Evergrande, and then also just looking at the PMI we're anticipating this week coming out of China. Let's just talk about that and how that is driving sentiments this week, and if markets are starting to accept that the picture in China is a little bit bleaker than what we had anticipated.
Yeah, I think the sentiments around China has turned decidedly quite negative, or maybe not negative per se, but less bullish than it was, say, last year this time. And I mean, that's a lot of that's coming from the fact that the recovery from that economy did disappoint to quite a large extent. But then also, as you mentioned, the Evergrande liquidation story really kind of just a nail in the coffin to this cautious stance and sort of this pull out of or rather a drawback in demand in terms of China, and how we've been seeing funds flowing out of that economy rather than the other way around. And so I think definitely the China growth and China demand story has been quite central to the commodities story. And as we've seen, the reduced demand from that economy, some of the economic indicators showing, pressure on across, that economy. And so we have seen some downbeat performances from the miners, from the local miners, but also some downgrades coming through and also putting extra pressure on share prices and the general outlook for commodities.
Bring it home. Truworths came out today with a bit of an update, and we're seeing the share price up just over 2%. Now, they've actually come out to say that they're expecting little to no growth. Interesting enough, they are the ones who are more bullish on credit. It just looks like the rope has run out for many of their consumers here, hence their inability to see meaningful sales growth. And of course, comparing them to their counterparts, which have had actually a more buoyant festive season than what we thought.
Yeah, it was an interesting. I mean, I had a quick look at these numbers just from an initial, or just an initial impression was that it was quite surprising to see that they had quite opposite trends to what the other retailers have shown. The SA business underperformed. The UK business, on the other hand, was much better. They sustained double-digit growth in that business, which was notable given the pressures in the UK markets. We've seen the consumer under pressure in that economy because of their specific economic risk and constraints. But they managed to deliver very strong growth despite those constraints, which I think they definitely outperformed the peer group locally. But the SA sales growth disappointed, and especially taking into consideration the festive season period, that they largely didn't benefit from any of that sort of generally higher demand during that period. And so they disappointed the sector from that perspective. And I think the likely impact there is around perhaps discounting. We saw from the other retailers, Foschini, for instance, they had better pricing in terms of pushing through full price and reducing their discounting, and so that was margin supportive for them. And so I think with Truworths, the opposite was true. The reality for them, probably they had weaker margins because of higher discounting for them. And as you mentioned, they are more exposed to credit trends. And as we've seen, credit markets have been tightening because of the sort of dampened outlook for consumers by lenders at large. And so I think definitely some of the things that impacted them during this period.
With that says, Taylor, let's move into our stock picks segment. So let's start off by reflecting on counters that have found favor with your industry peers.
Yes, I'm going to hang my hat on Mr. Price. Mr. Price put out a decent trading update yesterday with total sales up 10%. Consumers that are under pressure will perhaps be looking to shop down. We also know that Mr. Price is a cash business, and despite trading at low valuations, we don't think the stock is a value trap. In fact, recent momentum to the upside may just be the impetus that this counter needs going into this year.
I think South African shares are really cheap. We've seen what a little bit of good news can do to the retailers over the last few days. Little bit of good news comes into the system, they go up strongly. So I'm going to go for South African orientated shares, and it's one I picked a week or two ago. I'm going to go for a bank. I'm going to go for Absa. I mean, these are also very undervalued companies. They just need a bit of volume growth. They just need the economy to do a bit better. They just need interest rates to come down and loan growth to happen. You can get a half-decent return out of them. So I'll go for ABSA.
All right, so we're keen to get your thoughts on those, Mr. Price and ABSA, very briefly.
So, I mean, I like the value retail sector in general. I agree with sort of the down trading support to the business. Their updates was very strong relative to the rest of the sector, and again supporting that that value retail demand as consumers, I think, remain broadly under strain. Resilience given the economic conditions, excuse me, that we're under, but they do remain resilient in terms of the consumption patterns that we've seen to date. And then so for ABSA, oh sorry, what was that?
Please do continue.
Oh, so for ABSA, I think, yeah, I agree with the notion that SA income in general has remained quite cheap, and so banks within that space are looking attractive, and I think ABSA, in general, has generally underperformed the peers. They just reported just softer performance trends generally relative to the peers through the cycle. And so I think, yeah, definitely with easier economic conditions, we're likely to see some uptick in loan demand and loan growth, and that should be supportive of bottom line growth for them.
We don't have much time left. I think we've got about 15 seconds. We're keen to get your stock pick for today.
For sake of time, I like Cap Agri. I just like that exposure to agriculture. I think from recent updates, the El Nino cycle has not been as bad to the agricultural sector as anticipated, and so we're likely to see a more favorable weather conditions and a more favorable crop harvest, which should be supportive for the rest of the year.
Fantastic. Always a pleasure hearing from you, Sithembile. Thank you so much for your time. That was Sithembile Bopela. She's from FNB Wealth and Investments.